Risk management strategies in financial institutions. Financial institutions, whether they are banks, insurance companies, investment firms, or credit unions, operate in an environment rife with risks. These risks can arise from a variety of sources, including market fluctuations, credit defaults, regulatory changes, operational failures, and even external shocks such as natural disasters or cyber attacks. Given the potential impact these risks can have on their stability, reputation, and profitability, financial institutions must implement effective risk management strategies to identify, assess, mitigate, and monitor these risks. Risk management in financial institutions is not just about avoiding losses. It's about balancing risk and reward, optimizing performance, ensuring regulatory compliance, and protecting stakeholders' interests. This content explores key risk management strategies employed by financial institutions to safeguard their operations and maintain their competitive edge. 1. Types of risks in financial institutions. Before diving into strategies, it's essential to understand the various risks that financial institutions face. These include 1. Credit risk, the risk that borrowers or counterparties will fail to meet their financial obligations, resulting in financial losses. 2. Market risk, the risk of financial loss due to fluctuations in market prices, including interest rates, foreign exchange rates, and equity prices. 3. Liquidity risk, the risk that an institution will be unable to meet its short-term financial obligations due to an imbalance between liquid assets and liabilities. 4. Operational risk, risks arising from inadequate internal processes, people, systems, or external events, e.g., fraud, system failures. 5. Compliance and legal risk, the risk of regulatory penalties, legal disputes, or reputational damage due to non-compliance with laws, regulations, or ethical standards. 6. Reputational risk, the risk of damage to the institution's public image due to scandals, poor customer service, or other negative events. 7. Systemic risk, the risk that the failure of a single institution or group of institutions could lead to a broader financial crisis affecting the entire financial system. 2. Risk identification. The first step in any risk management strategy is the identification of potential risks. For financial institutions, this involves understanding both internal and external factors that could impact operations. Effective risk identification can help prevent significant losses before they occur. 1. Internal audits. Regular internal audits help uncover weaknesses in financial systems and controls. 2. Scenario analysis and stress testing. Financial institutions use scenario analysis and stress testing to identify potential risks under different hypothetical scenarios, including adverse market conditions or economic downturns. 3. Market intelligence. Staying informed about global and local market trends, geopolitical risks, and emerging technologies, like cryptocurrencies or AI in finance, enables institutions to anticipate and prepare for new risks. 4. Customer credit profiling. Analyzing customers' creditworthiness and financial behaviors allows institutions to identify risks in lending or investments. 3. Risk assessment and quantification. Once risks are identified, they need to be assessed in terms of their potential impact and likelihood. Risk assessment involves determining how severe the impact would be if the risk materialized and how likely it is to happen. 1. Value at risk, VaR, a common method for quantifying market risk. VaR measures the potential loss in value of an investment portfolio over a defined period at a given confidence level. 1. This helps institutions understand the worst-case scenario for their investments. 2. Stress testing and sensitivity analysis. Stress tests simulate extreme market conditions, such as a sudden interest rate hike or an economic collapse. 2. Sensitivity analysis assesses how sensitive a portfolio is to specific changes in market conditions. 3. Credit risk modeling. Institutions use models like the credit default swap, CDS, or credit scoring systems to estimate the likelihood of credit default and the potential loss given default. 4. Risk mitigation strategies. Mitigating risks involves implementing strategies that reduce the likelihood of risks materializing or their impact if they do occur. Financial institutions employ a variety of tools and techniques for risk mitigation. 1. Diversification. Diversifying investment portfolios, loan portfolios, and revenue sources is one of the most common and effective ways to reduce risk. 1. By spreading investments or loans across different sectors, industries, or geographies, institutions can reduce the impact of adverse events in any single area. 2. Hedging. Financial institutions use derivatives such as options, futures, and swaps to hedge against market risks, such as fluctuating interest rates or currency exchange rates. 2. Hedging allows institutions to protect themselves from losses in market value. 3. Collateral and guarantees. Securing loans or credit with collateral reduces the risk of default. 3. Similarly, financial institutions may require guarantees or letters of credit from third parties to reduce counterparty risk. 4. Credit limits. Setting credit limits for borrowers or counterparties helps prevent overexposure to any single customer or market segment, thereby limiting potential losses. 5. Insurance. Insurance products, such as credit insurance or cybersecurity insurance, help protect against specific risks, including credit defaults or data breaches. 6. Liquidity buffers. Financial institutions maintain liquidity reserves, such as cash or highly liquid assets, to meet unexpected cash flow needs without needing to sell off assets at unfavorable prices. 5. Internal controls and governance. Effective internal controls are fundamental in reducing operational risk. These controls ensure that business processes are efficient, transparent, and in compliance with relevant regulations. Good governance ensures that financial risks are managed at the highest level and that the institution is accountable for its actions. 1. Segregation of duties. Segregating key financial tasks, such as approving loans, managing funds, and auditing financial statements, helps prevent fraud and errors. 2. Risk management committees. Many financial institutions establish dedicated risk management committees, typically at the executive level, to oversee risk management activities and ensure adherence to risk policies. 3. Compliance programs. Robust compliance programs ensure that financial institutions adhere to laws, regulations, and ethical standards. 3. Regular training programs for employees and periodic compliance audits are key components of a solid governance framework. 4. Whistleblower mechanisms. Establishing anonymous reporting channels allows employees to report unethical or illegal activities, helping prevent operational and reputational risks. 6. Technology and cyber risk management. In today's digital age, technology plays a significant role in financial institutions. While technology provides efficiencies and new opportunities, it also introduces new risks, particularly related to cybersecurity and data privacy. 1. Cybersecurity measures. Financial institutions employ advanced cybersecurity measures, such as firewalls, encryption, multi-factor authentication, and intrusion detection systems, to protect sensitive data and ensure the security of online transactions. 2. Regular security audits. Frequent security audits and penetration testing help uncover vulnerabilities in the institution's digital infrastructure. 3. Data privacy regulations. Institutions must adhere to data privacy laws, such as GDPR or CCPA, to protect customer data and avoid legal and reputational risks. 4. Disaster recovery and business continuity plans. Financial institutions should have a comprehensive disaster recovery plan in place to ensure they can continue operations in the event of a cyber attack or system failure. 7. Regulatory compliance and reporting. Financial institutions operate in a heavily regulated environment. Complying with local and international regulations is crucial to avoid penalties, lawsuits, and reputational damage. Regulatory bodies, such as the Federal Reserve, the European Central Bank, and the Financial Conduct Authority, impose various requirements on financial institutions to manage risks and maintain financial stability. 1. Capital adequacy. Regulatory frameworks, such as Basel III, require financial institutions to maintain a minimum capital buffer to absorb potential losses during periods of economic stress. 2. Risk-based supervision. Regulators assess financial institutions based on their risk profiles, ensuring that they hold enough capital and have proper risk management systems in place to survive adverse conditions. 3. Stress testing and reporting. Regulatory bodies often require financial institutions to conduct regular stress tests and submit detailed reports on their risk exposures and capital adequacy. 4. Anti-money laundering, AML, and Know Your Customer, KYC. Financial institutions are required to implement policies to detect and prevent money laundering, fraud, and terrorist financing. 8. Risk monitoring and review. Effective risk management is an ongoing process. Financial institutions must continuously monitor and review their risk exposure to ensure that their strategies remain relevant and effective. 1. Key Risk Indicators, CRISs. These are metrics used to monitor potential risks in real time, such as credit default rates, liquidity ratios, and market volatility. 2. Continuous Risk Assessment. Regular reassessments of the institution's risk profile, especially after major events or changes in market conditions, help ensure that risk strategies remain effective. 3. Internal reporting and feedback loops. Regular reporting mechanisms ensure that risk data is communicated effectively across departments and that senior management is well informed about risk levels. Risk management is integral to the successful operation of financial institutions. The combination of a robust risk identification process, effective mitigation strategies, strong governance, and compliance with regulations allows financial institutions to manage risks while pursuing growth and profitability. In an increasingly complex financial landscape, where risks are evolving rapidly, financial institutions must remain vigilant, adaptable, and proactive in their risk management approaches to ensure long-term stability and success. By staying informed, leveraging technology, and building a culture of risk awareness, financial institutions can better navigate the challenges and uncertainties they face, ultimately protecting their assets and serving their stakeholders more effectively. In conclusion, the importance of effective risk management strategies in financial institutions cannot be overstated. In an increasingly volatile global economy, where risks are not only diverse but also interrelated, having a comprehensive and dynamic approach to managing these risks is crucial for ensuring the long-term sustainability and success of financial organizations. The strategies discussed, ranging from identifying and assessing risks to mitigating them through diversification, hedging, and effective internal controls, represent a multifaceted approach to managing the complexity of risks financial institutions face daily. The evolving nature of financial markets, the constant advancements in technology, and the complex regulatory environment mean that financial institutions must remain agile and proactive in their approach to risk management. Financial institutions that effectively balance risk and reward, while implementing safeguards, such as robust compliance programs, cybersecurity measures, and sound governance structures, are better equipped to navigate uncertainties and capitalize on opportunities. Equally important is the need for continuous risk monitoring and review. Financial institutions must be vigilant and responsive to changing market conditions, emerging threats, and regulatory shifts. This requires not only effective risk management tools and frameworks but also a culture that promotes risk awareness and preparedness at every level of the organization. The integration of technology and financial services has made it both easier and more complex to manage risk. While advancements in financial technologies, fintech, have created new opportunities for innovation and efficiency, they have also introduced new types of risk, such as cyber threats and data privacy concerns. The financial industry must ensure that technological progress does not outpace its ability to mitigate these new and evolving risks, making it essential to continuously invest in cybersecurity, data protection, and compliance systems. Moreover, risk management is not solely about protecting financial institutions from losses, but about positioning them for sustainable growth. By ensuring the effective management of risks, financial institutions can not only safeguard their assets but also gain a competitive edge in the market. A well-managed risk profile allows institutions to pursue strategic initiatives, expand into new markets, and innovate without exposing themselves to excessive dangers. Ultimately, risk management is an ongoing journey that requires a combination of knowledge, strategy, and adaptability. Financial institutions must be prepared to learn from past experiences, adjust their strategies in response to new challenges, and continuously refine their risk management frameworks. The effectiveness of these strategies will not only protect the financial institution but also enhance customer trust, regulatory compliance, and stakeholder confidence. In today's world, where uncertainty is a constant, the ability of financial institutions to manage risk effectively determines their resilience and ability to thrive. By implementing a holistic, forward-thinking approach to risk management, financial institutions can navigate the complexities of the financial landscape, mitigate potential threats, and position themselves for long-term success and sustainability. In the end, the goal of risk management is not just to avoid losses, but to create a foundation for growth, innovation, and financial stability that can withstand the challenges of an ever-changing world.